So what do you make, Robert, of where we are right now in the current state of housing? It seems like there's a bunch of different measures going on, but you still hear anecdotally people are putting bids on houses that aren't even for sale.
Yeah, so earlier this year, I shared that I believed 6% mortgage rates were accepted as the new normal. I think now we're in an environment where 7% mortgage rates are now the new normal, and people are accepting it. The data points I'd use are in the last month, 3 of the 4 weeks saw an increase in purchase mortgage activity. This week it was down 5%, but that's not much, and it's also what you would expect at this time in the spring market. Also, every month this year, the price of homes were higher than the month before.
What about the housing supply? I mean, how do we ever get over the shortage that we're seeing here? Is there really a long-term solution?
Well, the Fed can help if they bring mortgage rates back down. If they bring mortgage rates back down to a place where they're around 5%, I think we'll see a huge unlock of inventory. But until that time, there's a little bit of a silver lining in housing starts. Last month, we saw 1.6 million housing starts, the greatest numbers since 2016. Also, a third of the jumbo mortgages in the pandemic period were ARMs, and the majority of them were below 7-year ARMs. So the value of that financial asset is going to decrease every year. If it was a 5-year ARM in 2020, you have about a year and a half left.
When you say that 7% mortgage rates are now being accepted, it means by accepting it, if home prices aren't going down, you're paying a greater share of wallet of what you earn for housing, which at some point has to change the rent versus buy equation, doesn't it, when you have more rental supply coming on?
Yeah, so we're seeing housing deflation on price over a year-over-year basis on rentals by 0.5%. And so I think the Fed's done their job there. On sales, although it's been up on price every month this year, it's about 3% less than the prior year. And so I think we're seeing a normalization at this point between rent versus buy. The issue, again, is inventory, and we need to see an unlock in order to create more balance. But the issue that the Fed has, in order to bring down price, they're trying to prices in general. They're bringing up rates. But as you bring up rates, mortgage rates go up. And as mortgage rates go up, more inventory is unlocked. So they're in a kind of catch-22 where they're not able to actually bring down the value of these homes.
So what are you seeing then from sellers that may have a home that could be in high demand? But if they sell it, then of course they have to find a new place to live. They may then have to pay a higher rate than they're currently selling. I mean, how are they deciding that calculus if they want to unlock the value of the home, but then obviously they're going to have to pay more to live somewhere else?
So a few things. One, we're seeing more people buy without mortgages than in the past. So historically, it's been around 25% of buyers were all cash buyers. Now it's almost 40%. This is higher than the number I've ever seen.
Well, the Manhattan number is 65 in the last 3 months. Cash. It's incredible.
Yeah, so if you have cash, that's a way to get through this. But on the other hand, what we're seeing are more buyers that have to buy because you have to move. There are life events. People get married. They have kids. They have a new job. They have to return to office. They move to a Zoom market. What we're seeing them do is that they're buying a new home, but instead of selling their existing home, they're renting it out so they can have the financial arbitrage between low mortgage rates and high rents.
Wow. Since you mentioned it, with changes in work and the way that we live our lives, what's happening in some of these Zoom boom towns?
So the Zoom markets, there's not a Zoom market that I know that's doing well, right? And so you have Boise, Idaho, you have Salt Lake City. And so the demand that went there is coming back because CEOs across the country are expecting people to come back to office at different rates. The opportunity that I would see is in downtown San Francisco.
Oof.
And here's why. You just saw in Seattle, which is downtown, very similar to San Francisco, that there became a moderately robust market after Amazon required people to come back to the office. CEOs in downtown San Francisco will expect people to come back at some point. And when that happens, the downtown market, I believe, will surge in prices with it.
There's a lot that has to happen, though, in that San Francisco market to clean that up. Thank you very much for joining us, Robert. Very fascinating conversation.